Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how oil is getting absolutely crushed right now to the point where it's reached negative $3.70 per barrel today at the time of this recording. So that is a barrel of oil, okay? That is 42 gallons of crude oil. So you're probably wondering to yourself, how is this even possible? How can these barrels even get to a negative price in the first place? So we're gonna be talking about that and much more in this video. Before I get into the actual outline of the video, I just want to preface that most people may not realize that oil is in everything. It's in plastics, rubbers, transportation, logistics, waxes, jet fuel, a million things. Even if you think like, hey Marco, this apple that I'm eating right now, it's not made of oil. What do you mean it's in everything? Well, it took a truck to get that apple to the grocery store to get into your mouth and into your stomach, okay? The apple didn't just teleport to the grocery store. So before I start the video, just keep that in the back of your mind that oil is one of the biggest commodities in the world. So in this video, we're gonna talk about what's causing the drop, how it affects us and businesses, and most importantly, how to trade it and how to profit off of it, which will be the third part of the video. Stay till the very end, it's always the best. Thank you. So what is causing this huge decrease in the price of oil? Well, it boils down to basic economics. You have number one, which is the collapse in demand, and number two, which is the surge in supply happening at the same exact time. So this was actually at a very unprecedented time, but let's talk about collapse in demand first. So what is causing the collapse in demand? Obviously, everything that's going on right now, less people are traveling, period. Cars, planes, etc., and all those industries and product types use a ton of oil. By April 10th, consumption has fallen to the lowest level in 30 years for oil. Demand for gasoline since mid-March has dropped by 50%, which is one of the sharpest declines in history. And jet fuel consumption is down 70%. Factories are shut down. Obviously, factories burn oil, and the bottom line is collapse in demand, okay? Now, how come there's a surge in supply at the same time there's a collapse in demand? Well, most countries such as Saudi Arabia, Russia, Venezuela, and the United States were actually putting out record numbers of barrels per day. So the United States in February was putting out 13.1 million barrels of oil per day, which is its highest ever. And then you actually have Russia and Saudi Arabia putting out a ton of barrels per day, thus increasing the supply. So they typically conduct production cuts at the same time, so that way they can manipulate the price of oil. It's kind of like the diamond industry. So diamonds are perceived to be rare, even though they're not. So the supply is kept low, which keeps the price high, okay? So that's what they do with oil as well. However, about a month ago, if you watch my video, Russia and Saudi Arabia actually went to a price war, and Saudi Arabia just produced a ton of oil without cutting the supply, hence increasing the surge in supply. Now, on April 9th, OPEC and Russia actually agreed to a 10 million barrel per day cut, trying to cut down that supply to raise up the prices, but it was too little too late. So all these barrels are now piling up with nowhere to go. All the refineries are full, all the pipelines are full. So let's talk about how it affects us and businesses. Okay, so as a consumer or a business owner, you're probably wondering or thinking to yourself, how do I benefit from oil reaching negative $3.70 per barrel? Well, the first point is actually a reduction of transportation costs and consumer fuel. So whether you're a company that relies on fuel as one of your main expenses or exports or imports, or whether you're a person that drives a big V8 truck and you don't get that great of gas mileage, this is going to benefit you in both ways. So what this does is it'll allow you to increase your disposable income and increase the purchase of goods, whether it's for your business or as a consumer, you're purchasing consumer goods. The second point is that there's going to be a reduction in price of consumer goods. So there's actually over 6,000 items, consumer goods that are coming from petroleum, that come from oil essentially. So we should be seeing a reduction in costs. However, given the unique time period that we're in, companies are probably going to be hurting in sales, so we may not even realize those price reductions as the consumer. This is a very atypical time when it comes to the price of oil and the economy in general. So the third point is actually small oil firms are going bust, they're going bankrupt. They have billions in debt to fund their operation, so they have to keep pumping out oil to maintain that debt service, meaning paying the interest on their loans. However, once their main export, their main product gets slashed by 95% in one day, they're not profitable, meaning they will have to close down. Their product isn't worth the effort of staying in business. They just simply can't make the math work. And then finally, if we're talking on a super macro scale of countries in general, you have countries that will benefit that are importers of oil. So you have your Germanys, your Japans, your Indias of the world, for example. The countries that will get hurt by this somewhat are the exporting countries. You have the Venezuelas, the Russias, the Saudi Arabias, etc., etc. So the next section is all about how to trade oil and how to profit from it. And if you stayed along this far in the video, you're the real MVP. So let's go to the next section right now. So now that we know that oil is at an all-time low, how do we trade and make a profit from this situation going on? Well, these are 5 simple ways. Most of them will be common sense. Some of them you may or may not have heard of. So number 1 is stocks. This is the least complex and the easiest way to invest. This is literally just buying a company that will hopefully still be in business after this, such as like a Royal Dutch Shell, a BP, an Exxon Mobil. You may want to look at Halliburton, wink, wink, nudge, nudge. This is not financial advice. It's not investment advice. I'm wrong 110% of the time. Number 2 is ETFs. ETFs are essentially just an exchange traded fund. So most of you are already familiar with this. ETFs track an exchange or a basket of stocks. So you may want to look into ticker symbols USO, OIL, UCO, and I actually made a nice little profit on Vanguard's energy index fund called VDE. I was in and out of that about a month ago, and here's a screenshot if you don't believe me. Number 3 are most likely what you see when you see WTI or Brent crude index. We're looking at futures. So futures are simply just a contract that you make for the future. It's basically an agreement to buy or sell a quantity of oil at a specified date for a specified price. So if you look at the chart of oil or oil futures, the contracts for May, which are supposed to be taken delivery of on Thursday, were actually at negative $3.70 today at one point. If you look at June, they're a lot higher. So the sky is not falling, however, it is a huge indicator. A standard contract is for 1,000 barrels of oil, so a $1 price move in WTI, for example, signifies a $1,000 change, whether it's positive or negative in price movement. So these futures contracts are typically for the literal delivery. Try and say that fast. Literal delivery. Literal delivery of oil. It's actually not easy to say. So if you don't close or move these contracts, depending on what broker you're going through or what exchange, you will literally take delivery of these X amount of barrels of oil, okay? However, futures are very complex and high risk. You can make a lot of money, you can lose a lot of money because you're typically trading on margin. Number 4, options. Options is essentially a trader getting into a contract, paying a premium, meaning a fee well, I'm trying to simplify this. It's not really a fee. You're paying a premium for the right, but not the obligation to buy or sell a defined amount of oil at a specified price at a specified period of time. So you're not necessarily dealing in futures contracts in terms of taking the physical delivery of oil, but you are trading the futures, the options of the futures contracts as the underlying asset, okay? And then number 5, we can take the physical delivery of oil. Let's do it. Let's store it, baby. Come on, let's party. Let's fill up our swimming pools with oil. So people are literally chartering super tankers that have a capacity of 2 million barrels and literally buying oil at cheap prices right now and storing them until the price goes back up and making the difference of money on the arbitrage, okay? There's a city in America called Cushing, Oklahoma, which is a facility that's able to store 91 million barrels of oil, and they are exploding in terms of demand right now because people are shipping all their oil there and waiting for the price to go up. So I know I rarely talk about oil on this channel. I talked about it about a month ago in this video right here. However, I think it's super important to understand where we're going as a global economy once crude oil hits negative prices a barrel per day, okay? So I hope you got value out of this video. Share it with one friend, share it on social media. This is a super important subject that will have ramifications throughout the year. Hopefully we will level off at some point because this isn't really good for anybody unless you're in this business of trading. And ultimately, thank you for watching and have a prosperous day. I appreciate it. So let me get this straight. I'm gonna pay you $3.70 to take the oil off my hands. Sounds like a deal.